Katherine Pettey, and I'll be further discussing transaction-related objectives. Transaction-related objectives. What are they and why do they matter? Consider these objectives as a checklist of internal controls for the transactions of a company. Let's view these objectives through the eyes of an internal or external auditor, with the checklist being a tool. As long as we can check off each of these objectives, we can have reasonable assurance each transaction is being portrayed correctly. The first step is to decide if the transaction you are evaluating is dealing with A, recording a sale or acquisition of an asset, or B, recording an expense or liability. If A is chosen, we want to look to see if the sale actually took place or existed. There might be instances when a sale is recorded with no shipment, a sale is recorded multiple times, or items are shipped to a non-existent customer. Let's say I'm a salesperson of a company and I have to make one more sale for the year to meet my quota and receive a significant bonus. It can be very tempting to ship goods to a false customer just to meet my quota and receive my bonus. What we can do to ensure something like this isn't happening is to check to make sure there's a bill of lading and a sales invoice with every purchase order, or a three-way match. Standing data for all customers controlled by an employee separated from the sales department can also be beneficial. Pre-approving a customer's credit and having customer information on file prevents sales to fictitious customers. Now, let's go back and visit option B, recording an expense or liability. It might be advantageous for someone within a company to not completely disclose all expenses and liabilities. Lower expenses create higher profit, and many times the company's executives are evaluated on profit levels. By using the transaction-related objective of completeness, we can be reasonably assured that a company is fairly stating their expenses, liabilities, and profit. Pre-numbered purchase orders allow traceability for all purchase transactions. With the use of these, purchase can be traced all the way back to the purchase journal. Once it's been determined whether we should evaluate the transaction as existing or being complete, we have 4 more items that must be checked off our list: accuracy, classification, timing, and posting and summarization. Let's use an example to illustrate these. KP Incorporated sells gym equipment. A customer purchase order from CNC Gym for 20 treadmills is submitted on the 15th of December. Treadmills are priced at $500. A bill of lading, sales invoice, and the treadmills are received on the 28th of December by CNC Gym. KP Incorporated receives CNC's payment of $10,000 on the 15th of January. Let's recap. Would this example be subject to existence or completeness? We're recording a sale, so we want to make sure this sale actually existed. Since we have all 3 major documents, purchase order, bill of lading, and invoice, we can be reasonably assured this sale took place. We'd also want to check to make sure CNC Gym is on the standing data list. Accuracy is our next check mark. We want to make sure we record the correct dollar amount of the transaction. An example with CNC Gym, we'll want to check that $500 is the price per treadmill that is on the pre-approved price list. If we check and see that in fact the price per treadmill is $750, we will know that an error has taken place. The invoice should match what is on the pre-approved price list, and the amount recorded in the sales journal should match the invoice amount. Once we know the amount is correct, and we want to make sure we've classified the sale correctly. In our example with CNC Gym, we should record the transaction as a credit sale. Timing is next. In our example with CNC Gym, timing can be a bit tricky. The treadmills were shipped and received in December, but payment was not received until January. It's important to record the sale in the correct period, and in this case, the goods were shipped and received in December, so it should be recorded in December. The bill of lading date is a good guide on the date the sale should be recorded. Finally, we want to make sure we post and summarize the sale correctly. After shipping and billing CNC Gym, we'd want to make sure that the sale is recorded properly in the sales journal and the accounts receivable subsidiary ledger is increased. Once we receive the money, it's recorded in the cash receipts journal and decreased from the accounts receivable subsidiary journal. At the end of the period, we can foot and crossfoot to summarize the period amounts and then post to the general ledger. The ledger amount then flows to the financial statements. After all of these transaction-related objectives are checked off our list, we can be reasonably assured that the transactions with CNC Gym have been properly recorded. existence, completeness, accuracy, classification, timing, and posting and summarization. These are our transaction-related objectives. Thank you.